looking like out there for funding? Is are you seeing a slowdown in the number of companies that are coming to you? Is there a difference in the way people are pitching to you? What is your perspective? Has your lens changed? So just first, let's talk about newer investments and how are you looking at that whole scenario? Rajesh, do you want to go first?
Yeah, sure. Hi, Nandini. Can you hear me first of all?
Yes, I can.
Okay, great. So, like you said,
books that you have at the back. Yeah.
those are all to-do. That's a to-do list. I think interesting times. I've been involved in the markets since early 90s. I've had my fair share of bear markets and economic recessions, etc. This time feels different for sure. It's unlike what I've experienced, at least personally, before ever. We started off as a health scare, and unfortunately, it comes with an economic impact, and a big one in my opinion. So I'm not going to go into crystal ball gazing of when it will open, etc., etc. But I can share with you how we are looking at the ecosystem. How I'm approaching the situation, and what we are specifically doing with our existing portfolio companies, and also with potential companies which we are seeking to invest in. I'll keep my answer short, but if you need any more details, any more detailed discussion on any aspect, please just feel free to let me know.
Absolutely.
So first of all, our focus, if I were to just draw a pie chart, 60 to 70% of our focus is now on the existing portfolio. We have to make sure, like every investor would be, wanting to make sure that the portfolio companies that we have, see the end of the tunnel. Right? So we will be helping our existing portfolio companies in whatever we can, and it's not just about infusing more capital or just putting in more money. The focus is working very closely with them and making sure that cash flow becomes the central point of focus now. We have some companies in the portfolio where the business has gone down to zero in terms of revenues for the last nearly 20 days now. As and when the situation improves, what we've done in those cases is just cut down the costs to the bare bone minimum that we could. At the same time, making sure that employees on the rolls, founders, etc., are not just left with nothing in hand. So we're trying to balance that out. In terms of new investments, there were some very advanced conversations we were having before we hit this patch. We are making sure that we don't, paint everybody with the same brush. Some of those businesses will get impacted. Some of these businesses are reorienting themselves, and therefore they need a revaluation from our side or any investor side, because the whole business model might undergo a change. So I think these are times when you have to keep an open mind and approach the situation on a case-to-case basis. We are in a fortunate position at Equanimity that we have some dry powder left to make investments. So we try to balance using that money for existing investments as well as new ones. Does that answer your question?
Yeah. So, Rema, how about you? How are you seeing the environment? What are you doing with your investments?
Rema, could you unmute yourself, please? The microphone's on mute.
I think you guys muted me. Hello, can you hear?
I can hear you now.
So we are a second fund, and we just started investing out of a second fund. So for us, it's a full scale investment as usual as what we're doing. We in fact have 2 deals as we speak. We are in process of closing as we speak, right? So it's also the life fund and fund 2 of the. Obviously, we are looking to invest in. But yes, in terms, we've seen any reduction in terms of the companies that are flowing in. We have quite a lot of companies as flow seems to be.
Ma, sorry to interrupt. Your voice is breaking. I think there's some static at your end.
Is it better?
No, there is some.
Okay. Just check. Is this better now?
Yeah, maybe do you want to just log in again? I think that could work better. In the meantime, I'll just, take the question to Sid.
Okay. Yeah, okay.
You want to just take that question up?
Sure. So, I think to a large extent, we're a very concentrated portfolio. And so even in the best times, we spend a lot more time with our portfolio than we're looking at new deals necessarily to do. But I think we were looking at some new deals. And as you know, we had closed our third fund recently, only in August. And so we were in the process of doing a bunch of investments as a result of that, which we had done, but there were some investments that we hadn't completed yet. One investment we've completed during this time, in the last 1 month, and another investment that we're closer to completing. I think the one big thing I would say about closing investments, if you've I think, and we've tried to, I think across the community, most professionally run institutions are kind of hopefully following the same guideline, but this is not a time to take advantage of a situation that you've kind of committed yourself to investing in. At least that's how we're thinking about it. We invest for not the very long term, but it's a 10 to 12 year horizon. And I think a lot of the core aspects of what the kind of businesses that we try to invest in, and the way we look at businesses is very consumer oriented. So we don't look at SaaS businesses, for example. We just don't understand them as well. So we stay away. We look at India. And we look at technology in some way helping scale or give a competitive advantage to the business. And I think that the core elements of what we look for, we don't believe are really going to change over time. And so we've kind of stuck to maintaining the deal structure that we had. And I think one big part of that is that every time someone relooks at a deal structure, who you're really hurting is the entrepreneur. And because you're just taking more equity from them, which is really not what we want. I think that we try to make sure that the founder, no matter if we're going to do the deal and we've decided to do the deal, we want the founder to maintain whatever holding that they have. And so I think that's been critical in our conversations and letting founders know that don't worry, we're not going to move, we're not going to back out, so that they're not like going all over the place. And we'll also make sure that we don't renegotiate terms with you. And I think we've been trying to be very clear on that with those guys, the newer investments. I'm not sure necessarily we will look for new investments beyond that in the near future. We have a bunch of capital. I think we have over $100 million left, maybe $115 million left in Fund 3. So there's a lot of money available, and we'll have to spend that. But I think we're going to spend the next few months trying to make sure, just like Rajesh just said, kind of evolving our thinking for the current portfolio along with the founders and spending as much time on the ground, understanding on a day-to-day, week-to-week, month-to-month basis where they stand, what needs to change, and how they need to evolve. And from a mindset perspective, I think that hinders our ability to kind of look at new deal flow as much. Having said that, there's a constant desire to kind of learn and understand more. And so we're hoping we're able to do that as well. I fear people will struggle a lot with fundraising right now, and people bargain hunting or acquisitions being unnecessarily unfair because of the advantage people see in this environment. And I think that would be something that I've been trying to caution against. This is no one's fault. And the people that lose in these things are almost always the entrepreneurs and not the investor base. And so every time someone's trying to get a deal, renegotiate terms, or try to take advantage, short-term advantage of a situation that should, in many cases, support, let a company survive in the longer term, it's going to hurt that entrepreneur more than it's going to hurt anyone else. And that's a very unfortunate part of the ecosystem that we live in. So, but I suppose you can't control the larger pond that one swims in. But that's going to be the unfortunate part of how we come out of this, beyond the fact that some companies will not come out of it, but the ones that do, we'll have to see how crippled they are. And so one of the things that we will look for as we look at companies in the future, more so, is going to be ownership by the entrepreneur versus the investor base, because we fear that that's going to change considerably because of circumstances.
So, the good news is that from our side, because we are almost the first institutional investors that come in, in the game, we are actually not seeing a slowdown, which is quite good. We are seeing a good deal flow. We also are in the process of closing several deals. And I think that one of the things that are not changing during this environment is the individual investors' appetite to invest. Because, like in our network, we are not seeing investors backing out, or people are not saying that. What is happening is that they're asking more questions. They want to understand a pre and post corona world, and the ability of each startup to be able to handle it. But I don't think that there is a lack of funding at the level where we are. So maybe once. So I actually think that over the next, say, 3 to 4 months or 6 months, angel networks, like ours or anybody who's active, will actually be able to bring together a very good portfolio to funds which will be ready, who have tied through this time because the angels have invested. So, if, for founders who are out there listening to us, do try and look at investment not just from funds but individuals and networks, because you might find that they are more receptive. Though, like Sid mentioned, there could be very difficult and different kind of discussions around valuation, and that's something that we need to be a little cognizant about. So I'm going to move on to the next question on what Rajesh, you had just mentioned some time back on some companies where the revenue has started going down dramatically, and some which are not. So I'm just going to go quickly around the panel, just try and understand, if you could just give say 3 sectors that you think are going to actually do well at the end of this lockdown period, and 3 which you think are going to struggle to come back. So Rajesh, do you want to take that question?
Sure. Yeah. So, we don't focus too much on sectors, but I can give you real life examples, companies that we're struggling with, on a regular basis. One of our companies is a Mumbai Angels company, by the way, called Book Events. Of course, there are no events that are happening now.
Yeah,
so the business is just shut, right? And so we worked with them, brought down the cost base to nearly 1/3 now, renegotiated leases, etc., work with them continuously. So those kind of businesses which rely a lot on people coming together, I think this whole shared economy, which was really the talk of the town in the pre-COVID world, I think in the post-COVID world will need a very deep relook. You may not want to share an Uber ride pretty soon, even if you open up. So things like that, right? Hotels, convention centers, events, I think those will take a backseat. On the other hand, companies that we have in the portfolio doing well, fortunately for us, one is a company that delivers groceries. And it's another one which delivers fresh fruits and vegetables. Right, so 2 different businesses, but both doing extremely well. Of course, they are, and we talk to them mostly every second day. They're having a lot of issues and challenges on the ground at this time. Despite what the chief ministers and your prime minister says on the television, the police just doesn't let you move or open your warehouses or impounds your fresh vegetables, which is a loss if you can't sell it in a day or 2. So these kind of businesses which are delivering to the doorstep of families and people, healthcare, I think will do extremely well. So I think a simple way to look at it, and it's too early to say, to really categorize sectors. I think the way we are looking at it are those businesses which are very people intensive and need people to be together. I think will take a long time to get back to normalcy. Even if you look at Chinese data that's coming out, in some sectors, they've gone back to 70-80% of capacity utilization. In most of them, they're still at 30-40. So those businesses which don't require people coming together will, I think, continue to do well. And for all of us, that's a good thing, because we are all largely investing in the digital economy, which essentially means that you're using technology to deliver whatever service or product you're delivering.
Rema, are you online now?
Can you hear me now?
Yeah.
Can you hear me now?
Yeah. So Rema, how about you? Which sectors do you think are going
So
to
some of our core sectors, which is essentially around agri-tech, health tech, would continue to do well because these are non-discretionary, and people are going to continue to eat. And we actually see a lot of interest now in food tech startups and agri-tech startups. So there's going to be a lot of automation that would come into the farm labor because people would want to start using technology there. So agri-tech and health tech are going to, which are our core sectors, we're seeing a lot of interest, and we're actually getting a lot of proposals as well. So those I don't think would go away. Things that would, I think that could be behavior changes that are coming in would perhaps be in, let's say, in online education, for example, which so far has been a lagging sector globally, right? I mean, while there's been a lot of money that has gone into the sector, it has really never boomed as much. The consumer behavior could change in all of that. So technologies that would be for online, similarly in terms of tech-led telemedicine, variations of telemedicine, stuff around that, I think could definitely pick up in the next year or two, because I don't think things are going to go back to normal. This is going to be the new normal, right? And I think everybody would start now getting used to the fact that you could have a non-touch, you could have a virtual service being offered. So I think all those sectors which can actually move virtually would have obviously a huge upswing. We'd see that. And those are basically our core sectors, right? So we're seeing we actually are seeing the fact that we're going to be doing a lot well going forward, because our sectors are the next billion. So even in the next billion, people are looking to see how can I use technology to come online. So for example, one of our portfolio companies from our first fund just launched this so that non-vernacular guys can start interacting on the internet more easily, because even in rural India, everybody wants to now do it online, recharge online, everything online, right? So how do you do that? So I think those kind of sectors are going to have an uptick. Anything that requires a physical touch would obviously be difficult. I'm not sure I'm going to go into a parlor to cut my hair for some time. So those guys are going to have a bad time. So I think some sectors would definitely take a beating. Yeah, and to your earlier question, we continue to invest in all these agri-tech, food tech. We see that anything which is going to be discretionary could perhaps get 9 months. I think push out is what I would see that as, anything which is discretionary. But other than that, I think the investor interest continues to remain. I would urge all entrepreneurs to continue with their plans as they had earlier, just plan for a longer runway. That's all that I would say.
Sid, how about you? Which sectors you think are going to do well, which are not going to do well?
So, obviously our portfolio is probably significantly smaller than Rajesh or Rima's. We just make smaller amounts of bets with the capital that we have. So I think I'll be foolhardy to argue the sectors that they're talking about. But what I will do is I'll tell you which companies of ours, because we don't have that many, are in sectors that are moving forward in a much more aggressive manner, and the ones that perhaps need to wait for a while. So I think to Rajesh's earlier point on grocery delivery. So I think, again, scale makes a very big difference here. So our investment in Dunzo, where we're one of the largest shareholders, Dunzo is going to grow month on month, and while growing, massively improve their gross margin. So they're well on their way to taking, to not only being an essential service in the cities in which they are in. Unfortunately, South Bombay is not one of them, but they're and it's funny because, you know, as much as it's great that they're doing so well, this is the way that people are moving towards trying to do grocery delivery and essential services delivery at a hyper local level makes it sound like it's a very easy business to be in. And so everyone and their mother seems to be getting into this business now, which is funny because it's not that easy. And so unfortunately, my fear is that when you run a real estate company and suddenly start getting into essential services delivery, or you want to, you know, it can be anything right now. It's complicated, and it's dangerous. Same thing with food. We're obviously one of the largest shareholders in Rebel, and Cloud Kitchens is, you know, probably going to be the safest of the restaurant industry, and they're already up to, you know, where they were as far as kitchens are concerned before this lockdown. But oh my God, I'm so scared that people suddenly start thinking that food is going to be, you know, the next big thing for startups, because there's so many complexities in trying to scale a business like that. And, you know, Rebel's now 12 years old. And in this market, to try to say that I'm going to be delivering cooked food that I am making, I mean, I don't know how much trust people are going to have. I think trust is going to be core, and I think that's what at least these guys have been able to do. So they're also doing very well. I think agritech, what Remo is saying, is also very, very. It's a great sector. People need to get their fruits and vegetables. We have an investment in Waycool, and we're seeing that today. We're seeing that people are needing that, and they're being able to deliver it, and so that's great to see. I think online education, I think that Rima mentioned that. We have an investment in Imbibe, which we've sold to Reliance, and they just got a bunch of money from Reliance, and I think it'll be great to see how they now utilize that money, and how their plans kind of pan out. On the flip side, I think anything in retail, especially offline retail, anything in luxury goods, is going to be difficult. We have an investment in Bombay Shirt Company. We have an investment in Droom, which is a used automobile business. We have investment in Melora, which is a jewelry company. I think those companies are going to struggle to find bearings unless the lockdown is lifted. And once they are, we'll have to see how they kind of then move forward. Luckily, they all have enough runway and cash, so that we can wait this out and see and examine the circumstances. I think for those kinds of companies, they will have to think about how else to be able to make money. But hopefully it's not so far from their core that they have to start doing a whole new business line. For companies in that sector, I think business model makes a very big difference. So we have an investment in a subscription business called Furlenco. And Furlenco is now doing better than it's ever done before, because ain't no one leaving. And so, you know, and when you have ongoing revenue streams, I think those businesses can actually do very well in this market, as long as people feel like they need to continue to pay, because whatever they're using, like Netflix, for example, let's say, is core to their daily livelihood. And we don't need to be able to supply anything to you as a result of that. You just keep paying. And now I have zero cost, but I'm making the same amounts of money and a cash flow on a monthly basis. So even in the sectors like that, I think that, you know, businesses with more fortunate, I don't think there's a right or wrong model, but a more fortunate model for the circumstances that we're in can thrive as well. So in a nutshell, I think that's how we're seeing it pan out.
So, you know, I'm just going to shift the discussion a little bit from here. And see, I think the one thing that all businesses need to do is survive this, right? So you have to move through this to be able to stand at the other end and say, all right, I'm here now, what should I do, right? Now, Rajesh, I'm going to go back to you and saying, what are some of the strategies that you're recommending to your portfolio companies so that, you know, the runway becomes longer? Is there a painless way of doing it? Are there some specific things that one should look at first? Because what happens is that the first line item every company starts looking at is the people cost. Can you actually not go there? Can you do other things? Even within the people cost, are there painless ways of doing it? What are you seeing across your portfolio? You know, what are like some 2 or 3 key things you can share with the participants?
Uh, so I think this is a tough one. This is, we call it crisis because it comes with a lot of pain. So I think if you try to figure out a way, a painless way to survive the situation, hats off, please do share some things with us as well. Because I really feel this is not a 1 week, 2 week thing. No, this is going to drag out and there will be pain. The question is, can you optimize for survival? And I think that's what we've been talking to all our companies for. You're right that the biggest cost item there on the P&L is salary cost. That's the structure of the startups and early stage ecosystem. So what we've seen is in most cases, when you write to companies and companies write to their employees saying, okay, this is the situation, this is what the reality is. We've had examples of a few companies where they've willingly taken salary cuts. And it's not just the founders, but also the second, third layer. So there's a cutoff level that you have to keep, below which, we don't even ask for salary cuts. But up to a certain level, we do. And you'll be surprised by the contribution that people are willing to make, given this, because we all understand the situation at this time. I think the other way, obvious way, a painless way to deliver cost cuts is, obviously most businesses are now not planning for growth; they're all planning for survival. So the growth expense, the growth cost is simply vanishing. And you will see this reflected in the numbers of the larger internet giants globally, Facebook, Google, etc. A few businesses will still, which are largely digital businesses, online businesses, will continue to spend money online, but most others don't need to at this time. So that's a very, very simple way to cut back on costs. The third item, cost line item that we've attacked is rentals. In most cases, landlords have been very understanding, and they've willingly, not gone to zero, but they've arrived at whatever is an optimum level of cost there, reduction there. In one case, the landlord was very rigid and refused to cut down, the rental, etc. We've simply moved out. We said, okay, this is the notice, and 2 months rent is what whatever the commercials discussed and decided. We had to move out of that office. So I think we want to take these calls, and the focus completely has to remain on cash flows. Most of our businesses, in fact, we were on a call just before this one, where they've started sharing with us daily cash flows. So we are seeing on a daily basis what are the revenues that are coming in, what are the cash inflow based on the revenues earned, and what are the cost items. So you have to keep an hawk-eye on cash flow at this time.
Okay. So I understand we have only 5 minutes more before we open it up to questions. So Ankur and Sid, if you could just take a shot at this, very quickly on,
Sure,
what
I'll just.
Rima, right? Now, Ankur is a fund's name.
Just that I won't add to what Rajesh was saying, except for two things that I would say that one, we are looking at some of our companies that are actually renegotiating their contracts with vendors, being able to commit to, depending upon what the commercials are, giving a longer window for either, in terms of credit or in terms of being able to get better rates. So that's one thing, is in terms from vendors that whether it's as suppliers or essentially around machinery support, a whole lot of other things, right? So the vendor is one bucket that I would add to what Rajesh added, was one thing. The other thing is that in space itself, in many cases, because now you do see that for the next year or so, there's going to be remote working is going to be the norm, or you could actually do remote working in many cases. You could actually look at much smaller spaces as well. So that's the other thing that we are adding to the bucket, is one thing. The third that we are seeing is the fact that a lot of our companies are seeing some new opportunities of working with other service providers, other companies, startups in the space, who either have an online or part of it, or essentially just trying to increase their revenue streams. That's the other thing that we are seeing coming in. So trying to see what you can squeeze out from each drop that you could possibly get, and then see how you could survive for a longer period as well.
Sid, how about you?
So I agree. I think I agree with everything that Rima and Rajesh are saying. I think I mean, it's a company to company situation, and so it's difficult to make determinations until you know exactly where the company stands. One thing I will say is that along with all this the negative parts of cutting things, I think cutting either rent and having some negative impact on whoever is owed this money. I think a lot of companies, our portfolio and beyond, in the startup space, are looking at how they can also support, and I think that's a really, really big deal, and where they can support. So as much as they might not pay rent or um, or or larger buckets, I think they're making sure that they're able to support, like Rajesh said, the employees at the lower pay scale, but also outside of their business. If there are wage earners that aren't large vendors, etc., they're looking at how they can support them first. And companies that are actually working during this time, I think, are spending a lot of time trying to figure out how they can support the vendors that they're working with. So I mean, like Dunzo, for example, is their payment cycles with Kirana stores are a week, 10 days. Now they're doing it on a daily basis, just so that those Kirana stores can keep going. And I think that's just one example. I'm sure there are many. I think it's really encouraging to see how much money is being raised by some of these guys, some of the startups, how much effort is being put in to kind of support whatever their ecosystem is for people in need at the time, while trying to make the cuts in the areas which they find necessary in order for them to survive. So I'm gonna bring that part out.
So I'm just going to do one last question before we open it up. And this is, we're getting a lot of questions from founders and companies that are actually at the end of their runway, and they were in the midst of their fundraise, and now suddenly this thing has hit. So what is your recommendation for companies that were either about to embark into fundraising, or they were in the middle of it, and now this thing has suddenly hit? So Rajesh, do you want to go first quickly, because we have just about 2 or 3 minutes? What is your recommendation for companies, which can't wait maybe?
Yeah, sure. So we have a couple of first-hand experiences here. A couple of our companies were seeking capital, just getting into this situation. We've kept the process on in both the places, fully realizing that nothing else is going to come out of it. No meaningful conversations may happen in the next fortnight or so. But I think you cannot, in those cases, lift your pedal off the accelerator. You have to keep that process on. So I think first is you stick to the process. And for these companies, when you start raising capital, you have limited bandwidth in terms of the next few months of cash flow plan. And beyond that, you need that capital. So as I said earlier in my conversation, that you have to extend that runway. So companies that had a runway of 3 months and were hopeful of raising capital in that 3 months, I think you have to, make the dollar stretch a little bit further, and now plan to use that 3-month cash flow for at least 6 months or 9 months, if you can, right? Which essentially means your cost structure has to go down to half or 30%, 1/3. Not every business can do that just because of the construct and the business model, but any businesses that should extend the runway for now. And at the same time, continue the exercise of fundraising. Don't think that there are no investors out there. Nobody's going to make calls now. Nobody's going to invest capital. There will be misses, but I think there'll be enough hits as well. So keep at it. Keep at your process.
Rima, any other view on this?
Yeah, just say as a fact, anyone who survives in the next 3 months would definitely be able to attract capital, because all investors, would look at folks who have survived and would say, good, this person has been able to survive. So that shows something about the entrepreneur, right? So I would say it's fact to try everything, like what Rajesh said, try out everything that's possible, but just ensure that you are surviving. The guys who can survive would really be winners.
Sid, any other, specific points that we could, give out to founders so that they can survive this, raise money, anything?
It's a very unfortunate position to be in if you're in that position. And quite honestly, I would hope that if you're able to survive whatever is coming our way, that you can find money tomorrow. My only concern with a lot of those guys is that if your revenue is down to zero and you've basically survived with your last bottom dollar, I don't know what circumstances or what the company does, but raising money is going to be very tough. The next 6 months to 12 months, I think people are going to be looking for what they deem to be the safest bets to get into, and that's just a mindset that's going to be global in nature. I think companies that have models that have zero revenue and will take time to safe to prove out basic parts of their model are going to have a really tough time. So if you can continue to try to raise money right now, I would do it. I don't know where you would go to do it. I don't know how you can raise money from anyone who can't come and visit you, who can't come and see you. And if it is, it's going to be, small, tiny amounts of money. So while there is, travel is a concern, while diligence is a concern, tomorrow, if I can't get Big Four to do a due diligence on you or an audit on you, I don't know how we can give them money. So I think a lot of people will be in that situation. So I mean, maybe small amounts of money are possible, but I don't know how they're going to raise larger sums of money. And it becomes even harder if you've used all your money to survive and not to be able to do anything else during this time. And that's when you need more capital. So as much as I would hope that a lot of these things would work the way that are being played out by investors, I don't know. And I think one needs to take a really hard look at what they're doing during this time and where their business can go. Because if they need money, cut your valuation, cut everything, go down to whatever number, because the only time this game gets over is when you run out of capital. But it is a very complex, it's too complex to have a conversation like this in a more general way. It's very company driven, very specific. And it's a very complex world right now. So in some cases, I would say that, you should consider, even if you have some money, do you want to continue? And I know that's not the best thing to hear, but it's a conversation I would say that I would want to have if a company was in that circumstance.
So I think we've run out of time for our conversation. Shivangi, you want to now just put out the audience questions, and what we could do is that if they've asked for an answer from a specific panelist, you could just push it to them, or just let's open it up and one of us can just pick it up. So let's
open it up to the panel, because they've not really put down a specific panelist before. So what I'm going to do is I'm actually going to reverse the order. There are lots of sector-specific questions, and there are a lot of generic questions on valuations, government support, etc., which we can maybe look at later. Maybe since we have panelists who have invested in different baskets of companies, maybe we can tackle some of the sector-specific questions first, because there's a lot of curiosity in terms of how this will impact specific businesses and how they can move ahead in this time. So the sectors that have been highlighted are non-essential services such as fashion, internet and telecom, vegan ice cream, and including health food and other snacking, QSR and cloud kitchen, and the entire hardware space. So these are some of the sectors which are a concern to the audience present today.
Rima, do you want to take some of them, since some of these are in your portfolio?
Yeah, so one is at the health space, and I agree with what Sid had said earlier, that it's not that it's that simple, but there could be potential for health food startups as we go along, because there's more consciousness towards healthy food, building your immunity and stuff around that. So that's one area that we think that could be potential as one thing. Similarly, cloud kitchens as well, because basically there's going to be a lot more ordering in from cloud kitchens versus going to a restaurant. So those would be sectors that I would say is fun. Fashion, anything that's discretionary might find it difficult because it's not going to be easy. anything which is discretionary. There's going to be lots of job losses. There's going to be salary cutbacks. The amount that people would spend in some of these could go down is where we see that as. Hardware, I mean, hardware is too generic to put that out, but I would say is fact that some of these sectors that I would say that at a very generic level, these would be my feedback that I would say.
Rajesh,
Based on the sectors that she had outlined. Yeah.
So a few more that have come in are AI, media and advertising, schools, the entire education sector, which includes preschool, which I think could be impacted. So I'll just keep adding to the list as people.
So education, I do think that there's going to be a consumer behavior change, and that there's going to be lots more people who would be open to at least parts of it. They would like to see if they could do it online from home rather than go to a physical space for some time. So I think those are sectors that could potentially see where you could map out either that there is an existing demand or you expect that there's going to be a consumer behavior change or a different way of doing it. I think that's something that would definitely see potential.
Yeah. Rajesh, how about some of the other sectors that were mentioned? You know, I saw some preschool, online education, and I think there was some discussion on, you know, luxury items like vegan ice cream and just the vegan food industry. Some views on those.
Sure. Here's the way I think about it. So none of these sectors are going to die. Right? It's not that suddenly there are some sectors which will become completely negative and will not attract entrepreneurs and will not attract capital. The way I think about it is, investors bring capital to the table and entrepreneurs bring their lifetime to the table, right? So that's what they are contributing to the enterprise. And if entrepreneurs have enough confidence to set up an ice cream business, for example, just to take an extreme case, then I'm sure if you do it the right way, if you have enough, whether it's a niche product or it's a mass market product, if you are able to do a good job of executing that business plan what you have, you will find capital chasing you. So I don't think the whole conversation today for entrepreneurs is, should I shelve this idea completely and focus on something else? Because that's not how, at least in my opinion, entrepreneurship works. It's about what you believe in, what you are passionate about, and what you have the ability to execute. For me, every sector will remain open to for evaluation. Of course, if I look at a very short term, in the next 3 to 6 months, consumer discretionary items may not move up. But then I think Sid said at the beginning, we invest for 10, 12 years. For us, we invest for 7 to 8 years, which again is not a very short time horizon, though not very long term. But I think it's long enough and a runway for us to consider businesses holistically over the long run, rather than say next 6 months mein kya hoga.
Yeah, Shivangi, any different type of questions now?
Yeah, sure. So the next set of questions is actually concerns around valuation, more in terms of what would be the new yardstick for valuations. How do founders actually arrive at projections? Because you can't really look at discounting future earning at this point. And what would be the factors that investors would place a premium on? So if some of you can shed light on that in terms of how does a founder actually go about valuations in these times?
Sid, do you want to go first on this one? Has it changed post, the post-COVID world?
So I think, first of all, I'm assuming that the people that are asking the questions are very, very early companies and not later stage companies. And what I've always found with companies at a very, very early stage, and we don't necessarily invest in companies at that earliest stage, but it's not like there's a mathematical formula that's being used in the same manner as, let's say, a private equity fund would. Mm-hmm. And so I think part of the question was, discounted cash flow. I don't think that anyone's looking at discounted cash flow, making an angel investment. I do think mindset plays a very big role. And I think what the problem is that mindsets have changed. And so there is some fear. And I think that might have an impact on value and valuations. But I don't think that, just to elaborate on Rajesh's point earlier, I think that these industries, most industries aren't going to suddenly disappear. I love saying that in India you could start a shoelace business and you could become a multi-billion-dollar company if you can just do it right, similar to what Rajesh said. And I think that one part of doing it right now is your ability to figure out distribution in this context. So, and I think one thing that we would want to look at is we would add a black swan event like this into our artillery of questions. So in a circumstance like this, what would you do? How would you think, and how would you evolve? Not because they have the right answer or we know the answer to that question. It's just a matter of how you're thinking about it. So if you are selling vegan ice cream and you're saying, if I want to raise this much money, what do I value? Well, forget about that right now. Be able to explain with the money what you would do differently in order to overcome the circumstances that you're in right now. And I think valuation, you can't throw valuation out the window because that's your equity. But you're also looking for the investor that isn't also being overtly aggressive on value. And I think this is the biggest problem that most early stage entrepreneurs really have right now. They not now, always, they run after investors rather than evaluating investors. And this is a great way to evaluate an investor right now. Are they bargaining too hard about something that really isn't worth it because of the market circumstance today? And so I think evaluation discussions might be more mindset driven, but they shouldn't be so way off that you're suddenly giving away half of your company for the small amount of money that you're taking in an angel round, because that is going to hurt the investor as well as you as an entrepreneur in the future raising money, because ain't no one going to give you capital when you don't have that much equity in the game. So I think one should be careful of that. And I think there are plenty, and like you said in the beginning as well, there are there's plenty of cash on the table at a very, very early stage. There are plenty of investors, and what you really need to do is go out there and find it. And you got to do all the dirty work to be able to find the right investors, either through communities like Mumbai Angels or through other communities that are out there. But it takes work, it takes effort. You've got to be willing to get out there, get rejected, and maybe more so today than earlier. But there have been times like this. Maybe everyone hasn't been around for as long as Rajesh has been around seeing some of this stuff, but everyone's seen rejection. And so anyone who's seen anything has seen rejection. So I would be knocking on twice as many doors as I was expecting to, 3 times as many doors, just to be able to find the right people to kind of work with.
Completely. I completely agree on this. And I actually keep saying this to all founders and all platforms that I'm on, saying fundraising is a sales process, and which means that you have to know, and more so in the early stages than later stages, that your success rate is going to be 2%, which means that you will have to meet 100 investors to be able to zero down to 5 who are interested and 2 who will maybe put money. And that's the process that I think is going to become even tougher and more rigorous for founders who are out there. It's just that, like you said, you can't give up. You have to be out there. So like, for example, when companies are coming to us, it's not that they're not being able to raise money. It's just that the questions that are getting asked are, becoming more direct, more tough, usage of funds, runway, how are you going to survive these kind of events? Those things are happening. But I don't think founders at any point can say, hey, I'm not going to go out there and raise money anymore. And I do think, and I've said this in earlier this thing, that if there are 2 founders, maybe one should start looking at raising money as a majority part of what they're doing, especially in this environment. And if you need to raise that money.
And I would just add as a fact that they should raise more money than what they think that they would need, because basically the longer runway would help.
Absolutely. So Shivangi, I see we have only 5 minutes. Is there any specific question you think we should answer?
There is a lot of question around government support in these times, specifically for startups in terms of investment and how they can tide over this time. Is there something that you can comment on?
Rajesh, you want to take that?
Yeah, sure. So I think as an industry, the VC and NP community have been interacting with the government at various levels, but so is every other industry and every other sector. We've given them or shared with them a list of things that would be very nice to have for startups as a community, as an ecosystem. You must have read about a few of those asks in the newspapers or newsletters, etc. Whether that happens or not, I think the government has already started supporting the ecosystem in terms of I would recommend you guys go to the SIDBI website. SIDBI has rolled out the government has rolled out a plan through SIDBI for early stage companies to get avail loans. And the government has been very vocal in saying you got to come and register with us as a startup, and here are the conditions. So I think there's been a lot of transparency from the government side for the startup ecosystem. But the proof of the pudding is in the eating. If you go ask for the money, some companies are getting it already. Some companies, the process is on, and it doesn't have to be a VC-backed company. It can be an independent startup company as long as the government recognizes you as a startup. So I think there's enough and more that will happen. It's still early days. The government is also trying to get their arms around a lot of sectors, startups being one of those. So let's not be impatient with the government. I'm sure things will fall in place, but keep pursuing.
I would want to add here, that we need to be aware that the government is dealing, with too many things at the same time. And as a community, I don't think we can depend too much on government support at this point. What we can look for are relaxations, like I think those conversations have started in terms of taxation and, other payments and those kind of things. But to actually expect the government to come back and give you monetary support, I think we would be wasting precious time in which should otherwise be spent in trying to figure out solution between ourselves. I
would tend to agree 100%. I think the only time you can expect government support is if the industry that you're in somehow is able to convince the government to open up certain things that you need to be able to conduct business, whether that's in the agriculture space, essential services, healthcare, whatever it might be. And if your space doesn't, the government doesn't deem it fit to be able to support, it's going to be very difficult for you to be able to get it's the time that you take, just like you said, Nandini, the time that you could be spending somewhere else trying to get something that might not work out. And government funding, I think to a having large expectations around that is going to be a very low chance. And I think
yeah, absolutely. So Shivangi, I think we've run out of time for questions. I'm just going to quickly go around, the panel on any specific advice you want to give to our, so just to give you a sense, right now you have our portfolio companies, we have members who are active investors and a lot of startups from the ecosystem. So any last, one-liners that could help people get better grasp of what is going on. Rima, do you want to go first? Just rapid.
Sure. So one is that all entrepreneurs, and like I agree with what Rajesh said earlier, nothing is going to go away. There's obviously going to be lots of opportunities. So continue to plan your business, try to set them up, try to get them going. So entrepreneurs shouldn't stop. Investors shouldn't stop. It's just that you've got to be more careful and plan for a longer runway, have plan A, plan B, plan C in place. Contingency planning is what's required. But otherwise, I think all of us should look at this as just a temporary setback. And these are things that could open up new things for us. And this could be, a lot more opportunities are going to come up at the end of it. Yeah. So I urge everybody to stay positive and look forward to having a better conversation a couple of months down the road with everyone.
Yes. Rajesh?
Yeah, I mean, I try to seek optimism and opportunity in every state, and I can share with you my optimism for now. I understand we're all going through a tough time. All entrepreneurs on the call, you will have difficulty in managing the situation at this time, and also planning for growth, trying to raise capital. You'll be juggling much more than you were already juggling in your earlier pre-COVID times. VCs will have the same problem, by the way. Like Nandini said, for entrepreneurs, half of your job is to keep raising capital. I think for VCs, that's applicable as well, because remember, we also have to raise capital, right? So we are on the same treadmill. But the optimism comes from a very simple, if you look at a very macroeconomic level, and if you are really longer term in your thought process, simple thing is, do you think the government will print more money? The government will be loose with cash flow around? In my opinion, yes. If that happens, there's a big grouse that investors like us have had with the Indian economy for more than 20, 30 years, which is the cost of capital. India, the cost of capital is very high, which means businesses have found it very difficult to grow and sustain and compete globally. In my opinion, if you're really long term, this is a good time to get into business because cost of capital will come down over the next 3, 5, 10 years. Lower cost of capital will allow you to really scale up globally. So be at it. Focus on your business plans. It is going to be tough in the shorter term, but I think in the longer term, if you're able to execute on your vision, you will come out very, very successful.
Sid?
So I'll end on a different note. I think one thing we didn't get a chance to discuss, which is really, really important at this time as well, is HR and taking care of your employees, people that you work with, motivating them when they're home, and especially when revenue is down. And we've been saying, some companies down way beyond and even zero, keeping them safe, but yet keeping them working and moving in the same direction. While you're trying to raise money, if the lifeblood of your company fizzles away, it's going to be disastrous. And I know we didn't spend very much time on this call on that, but that's as important as any other part, if not much more important than any other part of the business that you have. So while everything else is important, please keep your eye on that. And I've never seen a time as hard as this to be able to do that. No financial crisis has had this kind of an impact on morale and people because of the distance that you are away from these guys at the same time. So
thank you so much. Shivangi, over to you.
Sure. Thank you, participants. Thank you, panelists, for this intriguing session. One request to all the participants is that we've shared a feedback link. I request you to please click on it and copy it into your browser, and do give us feedback for the subsequent sessions. Our next session of MA Reboot, Navigating the New Normal, is on To Fold or to Wait, Challenges of a Startup, which is on 16th April at 3:30 p.m. IST. I request all of you to join in and participate in that panel as well. Thank you once again for taking time out to join us this afternoon on MA Reboot. Have a good evening.
Thank you so much.
Thanks, everybody. Thanks. Bye-bye.